Basics of the stock market. The stock market is a platform where investors buy and sell shares of publicly traded companies. It serves as a critical component of the economy, allowing companies to raise capital while providing investors with opportunities to grow their wealth. Understanding the basics of the stock market is essential for anyone interested in investing. 1. What is a stock? A stock represents ownership in a company. When an investor buys a stock, they own a fraction of the company proportional to the number of shares they purchase. Stocks are also known as equities or shares. Types of stocks. Common stocks provide voting rights and potential dividends but have no guarantee of returns. Example: Apple Inc. AAPL. Preferred stocks usually do not have voting rights but provide fixed dividends, making them less risky than common stocks. Example: Bank of America preferred shares. Blue chip stocks. Stocks of well-established, financially stable companies with a history of steady earnings. Example: Coca-Cola. KO. Growth stocks. Companies expected to grow at a faster rate than the market average, often reinvesting profits rather than paying dividends. Example: Tesla. TSLA. Value stocks. Stocks trading at a lower price relative to their fundamentals, potentially offering long-term appreciation. Example: Johnson & Johnson. J&J. 2. How the stock market works. The stock market operates through exchanges such as the New York Stock Exchange, NYSE, and Nasdaq. These exchanges act as intermediaries where buyers and sellers trade stocks. Stock prices fluctuate based on supply and demand, influenced by factors such as company performance, economic conditions, and investor sentiment. Investors can purchase stocks through brokerage firms, either online or through traditional brokers. Stock market orders. Market order. Buy or sell at the current market price. Example: buying 10 shares of Amazon, AMZN, at its prevailing price. Limit order. Buy or sell at a specified price or better. Example: placing a limit order to buy Google. Google. At $2,500 when it's trading at $2,550. Stop loss order. Sell a stock when it reaches a predetermined price to limit losses. Example: setting a stop loss at $300 for Microsoft, MSFT, when bought at $350. Stop limit order. A combination of stop loss and limit orders to control execution price. 3. Key participants in the stock market. Investors. Individuals or institutions buying and selling stocks for profit. Brokers. Licensed professionals who execute buy and sell orders on behalf of investors. Market makers. Institutions ensuring liquidity by buying and selling stocks at publicly quoted prices. Regulatory bodies. Organizations like the Securities and Exchange Commission, SEC, oversee market activities to prevent fraud and maintain transparency. 4. Stock market indices. Stock indices measure the performance of a group of stocks. Some key indices include Dow Jones Industrial Average, DJIA, tracks 30 large U.S. companies. Example: McDonald's, MCD, Boeing, BA. S&P 500 includes 500 of the largest publicly traded U.S. companies. Example: Apple, AAPL, Facebook, Meta, Google. Nasdaq Composite focuses on technology and growth-oriented stocks. Example: Nvidia, NVDA, Amazon, AMZN. Russell 2000, measures the performance of 2,000 small-cap companies. Example: Crocs Inc. CROX. FTSE 100 tracks the 100 largest companies listed on the London Stock Exchange. Example: BP, HSBC, HSBA, L. 5. How to invest in the stock market. Step 1. Set investment goals. Determine whether you want to invest for long-term growth, income, or short-term gains. Step 2. Choose a brokerage account. Select a broker that offers the tools and services suitable for your investment strategy. Step 3. Research stocks. Analyze financial statements, market trends, and company performance before making investment decisions. Step 4. Diversify your portfolio. Spread investments across different sectors and asset classes to manage risk. Step 5. Monitor and adjust. Regularly review your investments and adjust based on market conditions and financial goals. 6. Risks and rewards of stock investing. Risks. Market volatility. Stock prices can fluctuate significantly. Example: Meta. Stock dropped 20% after weak earnings in 2022. Company-specific risks. Poor management or financial instability can lower stock value. Example: Enron scandal, 2001, led to bankruptcy. Liquidity risk. Some stocks may not be easily tradable. Geopolitical risks. Political instability and international conflicts can affect stock prices. Example: oil stocks fluctuating due to Russia-Ukraine conflict. Economic downturns. Recessions can negatively impact stock markets. Example: stock market crash of 2008. Rewards. Capital appreciation. Stocks may increase in value over time. Example: Amazon. AMZN. Stock rose from $18 in 1997 to over $3,000 in 2021. Dividend income. Some companies pay dividends to shareholders. Example: Johnson & Johnson. J&J. Has paid consistent dividends for decades. Hedge against inflation. Historically, stocks have outperformed inflation over the long term. Ownership and influence. Some stocks provide voting rights in company decisions. 7. Fundamental and technical analysis. Investors use different strategies to evaluate stocks. Fundamental analysis examines financial statements, earnings reports, and economic indicators. Example: analyzing Tesla's TSLA earnings reports. Technical analysis uses charts and statistical trends to predict future price movements. Example: using moving averages to trade Apple. AAPL. Quantitative analysis uses mathematical models and algorithms to assess stock performance. Sentiment analysis evaluates investor sentiment through news, social media, and market trends. 8. Long-term versus short-term investing. Long-term investing involves holding stocks for years, benefiting from compound growth. Example: Warren Buffett's long-term strategy with Coca-Cola. KO. Short-term trading includes strategies like day trading and swing trading, focusing on short-term price movements. Momentum investing. Buying stocks with upward momentum and selling when momentum slows. Value investing. Finding undervalued stocks with strong fundamentals and holding them long-term. 9. Conclusion. Understanding stock market fundamentals is essential for making informed investment decisions. While the stock market offers great opportunities, it also carries risks. Successful investing requires research, discipline, and a well-thought-out strategy. By learning the basics and staying informed, investors can navigate the stock market with confidence and work towards achieving their financial goals. Additionally, staying updated on global economic events, industry trends, and government policies can further enhance